Hello and welcome to another session of the My Solo 401k Financial My Community YouTube series. Thank you so much for your patience as we had some technical difficulties there. I think we're all set though and ready to go. So if you have questions, please chat those over. We're going to go through some good content here. And then the idea would be to field the questions at the end. Thank you so much. So let's get the presentation on the screen here. And we'll get going. Got some quick housekeeping. So today's topic is 2023-2024 Solo 401k Deep Dive Contribution Guide. This guide is geared towards partnerships, multi-member LLCs, so businesses that are taxed as a partnership, file a 1065. Get a K-1 as a partner. So we want to talk about and gear it towards that type of business in terms of really A to Z, all that you need to know in terms of making solo 401k contributions. So if you can't stay for the end, that's fine. Just subscribe to YouTube. You would be able to access the recording. You're going to get notifications of all of our great content. So the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. We've got a lot of great content on the docket here coming up. So subscribe for access to the upcoming webinars. For example, we're going to continue with these deep dive discussions. Again, today is focused on businesses that are taxed as partnerships or multi-member LLCs. We're also going to have a version of this webinar that's focused on those who want to make Mega Backdoor Roth contributions. Then we're going to go next to sole proprietors, single member LLCs, to really deep dive A to Z, what you need to know in terms of making solo 401k contributions for that type of business. We also want to talk about how much income you would need to be able to maximize contributions, right? That's for all types. Right? Whether your business is taxed as an S Corp or a C Corp, whether your business is taxed as a sole proprietorship, a single member LLC, whether your business is taxed as a partnership or a multi-member LLC. So, what's that magic number of income I need to be able to max out my solo 401k contributions? So we go through those different scenarios. So today's agenda is we want to start by understanding those contribution limits and the rules. We then want to apply that information, that knowledge, and apply it to different scenarios and examples to really illustrate how it works with some real life examples. Then we want to talk about the resources, right? We have an online calculator. We want to talk about the mechanics, the deadline, how to make contributions, how to report contributions, what is not a contribution. And then we've included some bonus content of the $1,500 solo 401k tax credit. So whenever we talk about making contributions, we always start with the fact that one's ability to make solo 401k contributions depends on different factors. One factor is your income. You can't save more than you earn. So it's going to be specifically your self-employment income. Another is your age. Another is whether you make contributions to another plan, like a day job plan. Lastly, what type of contribution you're trying to make, right? Is it pre-tax or Roth or voluntary after tax? Is it an employee versus an employer? So all of those factors will impact how much you can contribute. So for businesses that are taxed as partnerships, multi-member LLCs, your self-employment income is based on what is reported on line 14 of your K-1 after reducing by 1/2 of the self-employment tax. So you have to run a pre-calculation. Now, keep in mind, you don't consider W-2 wages from other sources like a day job. You don't consider investment income, right? The whole point of any 401k is for those who work to be able to save for retirement. And the point of a solo 401k is for a self-employed individual to save for retirement. So it's got to be based on that self-employment compensation. So again, you have to run a pre-calculation. You start with line 14, code A of the K-1 that you would have received as the owner, as a partner of the partnership. Then you have to reduce that by 1/2 of the self-employment tax. Our online solo 401 calculator, the one that I'm that referred to before, and we're going to talk about a little bit in a few slides here, that'll run that calculation for you. Now let's talk about the limits, right? So when you talk about the limits, it's important to understand that there's different limits to consider, right? There's the overall limit that applies to the sum of all the contributions that you make. And then there's also separate limits depending on what type of contribution you're trying to make. So for 2023, the overall limit is $66,000 plus an additional $7,500 if you're 50 or older. For 2024, the limit increased to $69,000 plus an additional $7,500 if you're 50 or older. So that's the consequence of inflation, right? How much you can contribute to the solo 401k goes up. So now let's start to zoom in, right? So in the words of the IRS, you're both the employee and the employer. So you can make different types of contributions. And then if you have a plan like ours that allows for it, you can also make different types of contributions in terms of whether it's pre-tax versus Roth or even voluntary after tax. So for employee contributions, those contributions can be made as pre-tax or Roth or voluntary after tax or in some combination of all of the above. Now, the employee contribution limit applies at the employee level. So if it's a pre-tax or Roth employee contribution that you're looking to make, that would be reduced by any contributions that you make to a day job plan. Because again, that employee contribution limit applies at the employee level across all the plans that the employee makes contributions to. Whereas the employer contribution limit applies at the plan level. So even though one might make contributions to a day job 401k, that's not going to impact how much that person can contribute to the solo 401k. Now, those employer contributions historically could always be made just as pre-tax contributions, but since Secure Act 2.0 can now be made as Roth contributions. And we'll talk more about what that means here in a few slides. Now, historically, again, Roth 401k contributions were always just made as employee contributions. But now with Secure Act 2.0, those employer, if your plan allows for it, like ours does, employer contributions can be made as Roth contributions as well. Since employee contributions can be made as Roth contributions, that's also going to include the catch-up, $7,500 catch-up amount that applies once you're age 50 or older. And then lastly, voluntary after-tax contributions. So even though these are a type of employee contribution, the limit really comes from a different section of the code. So it's not impacted by contributions that you make to another plan, like a plan sponsored by an unrelated employer, like a day job 401k plan. Voluntary after-tax contributions are not going to include the catch-up contribution, so the $7,500 that applies once you're 50 or older. So that gives us a good introduction to all of these different contributions. Now let's keep digging deeper, and we're going to really elaborate on all these good points. And then we're going to apply these rules to different scenarios to really illustrate how it works. So now let's dig deeper, first of all, on the employee contributions, specifically pre-tax employee. So when we talk about employee, another phrase for that would be a salary deferral. So employee contribution, salary deferrals, these are synonyms. So the limit is 100% of your self-employment compensation, dollar for dollar. So remember, for a business that is taxed as a partnership, self-employment compensation is line 14 of your K-1 less 1/2 of the self-employment tax. And then if you have set up a plan, if you had set up a plan before the end of 2023, you're going to be able to make employee contributions for 2023 all the way up until your business tax return deadline, including any timely filed extension. And you're going to be able to contribute 100% of your self-employment compensation, dollar for dollar, up to $22,500, plus an additional $7,500 to catch up if you're 50 or older. Now for 2024, the limit increased from $22,500 to $23,000. and the catch-up stayed the same, $7,500. Now, remember, the employee contribution limit applies at the employee level, so you have to reduce it, how much you can contribute to the solo 401k by any contributions that you make to another plan, like the day job plan, day job 401k, unless the other plan is a 457 governmental plan, in which the contributions are not aggregated. Now, these contributions can be made as Roth contributions if you have a plan like ours that allows for Roth employee contributions. In that case, the contributions need to be deposited into a separate sub-account. So now let's shift over and now let's go deeper on the employer contribution limit and how that works. So employer contributions, they're also referred to as profit-sharing contributions. They're also referred to as non-elective contributions. These are all synonyms referring to the same type of contribution. So the limit is 20% of your self-employment compensation. For a business that's taxed as a partnership, a multi-member LLC taxed as a partnership, businesses filing the Form 1065. And again, self-employment compensation is line 14 of your K-1 less 1/2 of the self-employment tax. So you have to run a pre-calculation, and then of that amount, one can contribute 20%, provided that the sum of all the contributions that you're looking to make to the solo 401k don't exceed the overall limit, $66,000 for 2023, or $73,500 if you're 50 or older. For 2024, $69,000 or $76,500 if you're 50 or older. So let's see here, real quick, cleanup. So you do not use the W-2. So just to be clear on that. Again, you take line 14 of the K-1 less 1/2 of the self-employment tax. Now, the employer contribution limit applies at the employer level. So per the last bullet here, it's not impacted by contributions made to another plan through an unrelated employer like the day job 401k plan, unless those contributions are being made to a 403b. In that case, you have the 403b exception to that general rule that you don't have to consider contributions made to another plan. So any contributions that are made to the 403b, whether it's by the employee or on the employee's behalf, like an employer contribution, together with any contributions that you want to make to the solo 401k, can't exceed the overall limit. So you do have to aggregate those 403b contributions. So it's Secure Act 2.0. Now employer contributions can be made as Roth contributions if the plan supports it, like ours does. Now, practically speaking, this has not been very impactful or used, I should say, also by our clients, because for our plan, it is always allowed, even before these employer contributions could be made as Roth contributions, it is allowed voluntary after-tax contributions, which is how one makes Mega Backdoor Roth contributions. So for someone whose goal is to maximize funds going into the Roth solo 401k, and they have a plan like ours that allows for the voluntary after-tax, right, this has not really been impactful. And so most have just declined to make the employer contributions as Roth contributions. Why is that? Well, the limit that applies to voluntary after-tax contributions is 100% of your self-employment compensation. So you don't, as opposed to the employer limit, right? We just read that it's 20% of the self-employment compensation. So all things being equal, you'll need a much greater amount of self-employment compensation to justify an employer contribution as a Roth contribution, whereas you can make voluntary after-tax contributions 100% of your self-employment compensation as a voluntary after-tax contribution, so you can more quickly and easily reach your contribution objectives. So that would be the first reason why individuals would decline to make employer contributions as Roth contributions when they have the option to make contributions as voluntary after-tax contributions, because they have a plan like ours that allows for voluntary after-tax contributions and then in-plan conversions from the after-tax solo 401k sub-account to the Roth solo 401k sub-account. Number two, the deadline is the same. So regardless of whether you're trying to make employer contributions or voluntary after-tax contributions, the deadline is the same, right? So even for 2023, one could still set up a plan and make here in 2024 and make 2023 employer or voluntary after-tax contributions, as long as the plan is established in time to make those contributions by the business tax return deadline, including any timely filed extension. So making the contributions as employer Roth contributions is not advantageous from a deadline perspective because it's the same deadline. Lastly, you have more flexibility when it comes to voluntary after-tax contributions in terms of being able to transfer those contributions out to a Roth IRA. So some individuals' objective is to make the voluntary after-tax solo 401k contribution and then transfer the funds out of the plan to a Roth IRA. So typically, you can't transfer funds out of a solo 401k, even if it's going to another retirement account, until you've met a triggering event, such as being at least 59 and a half years of age. And that rule would apply to employer contributions made as Roth contributions. So if you wanted to transfer those employer contributions made as Roth contributions, you got to meet a triggering event before you could do that. Whereas if you made those contributions as voluntary after-tax solo 401k contributions, and your plan allows for the immediate transfer out to a Roth IRA like ours does, then you could do that, right? You don't have to meet a triggering event. You don't have to be 59 and a half years of age. So that you have more flexibility. Therefore, most would choose to just simply make those contributions as voluntary after-tax contributions as opposed to making employer contributions as Roth contributions. But let's assume someone still wants to make the contributions, the employer contributions as Roth contributions. So here are some frequently asked questions. Do I need to deposit those employer solo 401k contributions made as Roth solo 401k contributions in a separate account? The answer is no. Both employee and employer's contributions made as Roth solo 401k contributions can be deposited into the same account. As part of the onboarding process for our clients, we're helping clients open up accounts at the bank or brokerage of choice. What is the contribution limit, right? We just have seen that it's 20% of self-employment compensation. So it's the same limit regardless of whether the individual wants to make the employer contribution as a pre-tax contribution to reduce their taxable income or make it as a Roth contribution where you got the potential for tax-free growth. Lastly, if you do end up making employer contributions as Roth contributions, how do you report those contributions? Well, this was an open question for almost a year after the Secure Act was enacted. Per IRS Notice 2024-2, they've now clarified how those employer contributions that are made as Roth contributions need to be reported. And what the guidance states is that the employer contribution is reported as tax deductible on the employer's tax return for the year for which the contribution is made. So you're effectively, if you're making that employer contribution as a Roth contribution for 2023, in the year 2024, which you can do as long as you do it by the business tax return deadline, including any timely filed extension, it's going to reduce the income on the employer's return for 2023, but then it's going to be taxable to the employee for the year of the deposit, 2024. And that gets reported by issuing a 2024 1099-R to the employee so that now they can include it on in their income that's reported for 2024. So you reduce it for the employer for the year for which the contribution is made, but then you add it to the employee's income because it's a Roth contribution, so it's got to be taxable, for the year of the deposit. So from a reporting perspective, it's very similar to as if the employee had made a deductible employer contribution, so pre-tax, but then immediately did an in-plan pre-tax to Roth conversion, which then would have made it taxable. And you don't have to go through those mechanics of first depositing it into the pre-tax and then moving it to the Roth. But from a reporting perspective, it's going to be the same. So they answered that clarity. And now we know how it needs to be reported. So now let's go to the voluntary after-tax contribution limit, and then we'll start to apply these limits to examples and scenarios to see how it works. So voluntary after-tax is how one makes Mega Backdoor Roth contributions. In simple terms, that's because the voluntary after-tax contribution limit is higher than the Roth limit. Remember, historically, employee contributions were the only type of contributions that could be made as Roth contributions. And we just saw that the limit is $22,500 for 2023, $23,000 for 2024. Now we've added on with Secure Act 2.0 the ability to make employer contributions as Roth contributions, so that that helps. But the voluntary after-tax contribution limit was already the overall limit, right? Because the voluntary after-tax contribution limit is 100% dollar for dollar of the self-employment compensation up to the overall limit. Keep in mind, for a business taxed as a partnership, self-employment compensation is line 14 of the K-1 less 1/2 of the self-employment tax. So hence the Mega Backdoor Roth, because if for someone who wants to contribute more than just their employee or even what their employer contribution, the employer contribution limit would allow, and they have the self-employment compensation to justify it, they could go all the way up to the overall limit as a voluntary after-tax contribution and then just simply move the funds over to the Roth solo 401k. So at the end of the day, they got $66,000 for 2023 in the Roth solo 401k or $69,000 in the Roth solo 401k for 2024. Now, of course, you do have to consider the overall limit. So that's what we mean when we say reduced by any employer or employee contribution. So the sum of employee, employer, and voluntary after-tax contributions that are made to the solo 401k cannot exceed the overall limit. Now, note that bracket here. Ignore any catch-up contributions made to the solo 401k. So you don't have to reduce how much you can contribute to the solo 401k as a voluntary after-tax contribution by any catch-up contributions that you made, because say you're over 50 and you made a $7,500 catch-up contribution. So you don't have to reduce how much you can contribute as a voluntary after-tax by those catch-up contributions. But at the same time, the voluntary after-tax contribution limit doesn't go up when you're 50 or older. So at the end of the day, you still end up being able to contribute $73,500 for 2023 if you're 50 or older and you got the self-employment compensation to justify the contribution, or $76,500 for 2024 if you're 50 or older, and again, you got the self-employment compensation to justify the contribution. Let's hit those last couple bullets. It's not impacted by contributions made to another retirement plan, like the day job 401k plan, unless the other plan is a 403b, in which case you have to aggregate all contributions made to the 403b, whether by the employee or the employer, along with any contributions that you would make to the solo 401k, and the sum of those contributions cannot exceed the overall limit. And that's because even though it's a type of employee contribution, really the voluntary after-tax contribution limit comes from a different section of the code. So you just look at the plan level. Now, at the same time, so in that way, it's like the employer contribution, right? Where it's not impacted by contributions made to a day job 401k. But it's like the employee Roth contribution in that you need to put those voluntary after-tax contributions into a separate sub-account. So this is why individuals will end up with maybe three different accounts, right? If they're looking to make pre-tax, Roth, and voluntary after-tax contributions, or if there's two participants in the plan, like a husband and wife that are both working in the same business, now they got 6 different accounts, right? Pre-tax, Roth, and after-tax for each. So now let's start to apply these rules to different scenarios. So the way we're going to do it is we're going to set a baseline scenario, and then we're going to change the different elements to illustrate how these rules work. So let's assume that it's a self-employed business, taxed as a partnership, multi-member LLC, taxed as a partnership. It's one person who's under 50, doesn't make contributions to another plan. Their goal is to first maximize pre-tax before they then make, if any, contributions as Roth and or voluntary after tax. Let's assume they've got $100,000 of self-employment compensation. Remember, that's line 14 of the K-1, less 1/2 of the self-employment tax. We're going to assume that all employer contributions are made as pre-tax contributions for the reasons discussed up above. So in this scenario, this person is going to be able to contribute $22,500 for 2023 as a pre-tax employee, because remember, they can do 100% of their self-employment compensation up to $22,500. For 2024, they can contribute $23,000 as a pre-tax employee. Next, they're going to, their goal is to first maximize the pre-tax. So next, they're going to go to the employer contribution. They can do 20% of their $100,000 of self-employment compensation. So that's another $20,000. And then they're going to be able to do the difference, right? They're not going to be able to make any more Roth contributions. They've already maxed out their employee and employer. but they can go to the voluntary after tax, and they're going to be able to do the difference up to the overall limit. So for 2023, that'd be another $23,500. For 2024, that'd be another $26,000. And then they can move that voluntary after tax contribution over to the Roth solo 401k. So at the end of the day, for 2023, this person would have $42,500 in their pre-tax solo 401k account between the employee and the employer contributions, $23,500 in their Roth solo 401k account after they made a voluntary after-tax contribution to a separate voluntary after-tax account before it was then moved over to their Roth solo 401k. For 2024, this individual would have $43,000 in their pre-tax solo 401k account between their employee and employer, and then $26,000 in their Roth solo 401k account after making an after-tax contribution and then moving those funds over to their Roth solo 401k. Now let's go back to the baseline scenario, and instead of $100,000 of self-employment compensation, remember that's line 14 of the K-1, less 1/2 of the self-employment tax for a business tax as a partnership. So you got to run that pre-calculation. So $50,000 though, let's assume after you've run that pre-calculation, it's $50,000. How much they can contribute? Well, their employee limit would stay the same, right? It's 100%. They've got the income to justify it. $22,500 for 2023, $23,000 for 2024. Now for their employer limit, it's going to go down because it's 20% of 50 instead of 20% of 100. So that's $10,000. And then they're not able to make any more pre-tax contributions to the plan. There's no Roth contributions that they can make at this point, but they could still make after-tax contributions. Now, this is a good scenario to illustrate that the voluntary after-tax contribution limit is the lesser of your self-employment compensation of the overall limit, right? So here, $50,000 is less than the overall limit, obviously. So you'd also have to reduce it by any employee or employer contributions that were made to the plan. So for 2023, that means that person could contribute $17,500 as a voluntary after-tax. For 2024, they could contribute another $17,000. So the sum of all the contributions to the plan is going to be $50,000 in each year. Hopefully that makes sense. So now let's go back to the base. The person now has $100,000 of self-employment compensation, but here they have a day job and they max out their contributions to their day job plan, right? $22,500 for 2023, $23,000 for 2024. So they've already maxed out their employee limit. Remember, so this is a good scenario that illustrates that the employee contribution limit applies at the employee level. So here the individual maxed out contributions to their day job plan. They can't make any more employee contributions to the solo 401k, but it also illustrates how the employer limit is not impacted by contributions made to the day job 401k plan. So they can still contribute that same $20,000 that they were to contribute in the baseline scenario. It also illustrates that the voluntary after-tax solo 401k contribution limit is not impacted by contributions made to a day job plan. So now they're going to be able to go up to the overall limit because their compensation is greater than the overall limit. So they got the income to justify contributions all the way up to the overall limit. So that's $46,000 as a voluntary after-tax contribution for 2023, $49,000 as a voluntary after-tax contribution for 2024. They could then move those funds over to the Roth solo 401k. So for 2023, they'd have $20,000 in their pre-tax solo 401k account based on an employer contribution, $46,000 in their Roth solo 401k account after making an after-tax contribution and then moving the funds over to the Roth solo 401k. For 2024, it'd be the same 20 in the pre-tax account, but now they got $49,000 in their Roth solo 401k account. So now let's go back to the base. This person, again, doesn't make contributions to another plan, $100,000 of self-employment compensation. They're not interested in making pre-tax contributions. Their goal is to maximize Roth and or voluntary after-tax. So in this scenario, they're going to make the full employee contribution, but instead of making it as a pre-tax, they're going to make it as a Roth solo 401k contribution. So $22,500 for 2023, $23,000 for 2024. They're going to decline to make employer pre-tax contributions because they're not interested in making those contributions. And now they're just going to make the difference as a voluntary after-tax contribution. So for 2023, that's going to be $43,500. For 2024, that's $46,000. And then they can move those funds over to the Roth solo 401k. So at the end of the day, in that Roth solo 401k account, they'd have $66,000 for 2023, $69,000 for 2024. So now let's go back to the baseline scenario, but now we're assuming there's two participants, right? It could be a husband and wife that are both working in the same business, two business partners. So the limits don't change. So what this scenario illustrates is that one's ability to contribute to the plan is based on each person's scenario. And here we're assuming there's two individuals that are both working in the business. They both have $100,000 of self-employment compensation. They both have the same objectives of first making pre-tax, and then with whatever is left, making those contributions as Roth or after tax. They both don't make contributions to another plan. So their contribution amounts are going to be the same because they get the same profile. So it's just a good illustration that it's each person's ability to contribute is based on their scenario. So now we go back to the one participant scenario, but what we're changing here is that the person is 50 or older. So how does that change? So what changes is now the individual can make a $7,500 catch-up contribution for 2023 and for 2024. Their employer pre-tax contribution amount is going to be the same. Their after-tax amount is the same. So this is a good illustration of how that voluntary after-tax limit doesn't go up when you're 50 or older, right? You make the catch-up, you make the additional amount as an employee, in this case, a pre-tax. But you also don't have to reduce how much you can contribute as a voluntary after-tax by any catch-up contributions that were made. So here they have to reduce it by the $22,500 employee, the $20,000 employer for 2023, leaving $23,500 for 2023, and then using the same calculation, $26,000 for 2024. So now let's go back to the base. Here again, it's one participant, under 50, $100,000 of self-employment compensation. They've maxed out contributions to their day job plan. They're not interested in making pre-tax contributions to the solo 401k. So this individual is not going to be able to make any employee contributions to the solo 401k because they've already hit their limit to the day job 401k plan. They're not interested in making pre-tax employer contributions. They're only interested in making Roth or after tax. So in this scenario, they're going to make the full contribution as a voluntary after-tax solo 401k contribution. $66,000 for 2023, $69,000 for 2024. So now let's go back to the base. It's a one participant, 50 or older. They maxed out to their day job. Again, they're not interested in making pre-tax, only interested in making Roth or voluntary after-tax. So they're making $30,000 for 2023 to their day job plan, or $30,500 for 2024 to their day job plan. So this is a good illustration that it doesn't change the calculation, right? It's still same scenario. They can't make any employee because they've already maxed out to the day job plan. They're not interested in making employer because they're not interested in making employer pre-tax contributions. So they just make the full they make the full $66,000 for 2023 as a voluntary after-tax. They make the full $69,000 for 2024 as a voluntary after-tax solo 401k contribution. So now let's go back to the base. We're now back to two participants. Each person's maxed out to their day job. Each person's only interested in making Roth or after tax. Each person has $100,000 of self-employment compensation. So how is it going to work? One second. Thank you so much for your patience. One second. Thank you so much for your patience. All right, so now we're ready to review how what it worked in this scenario. So it's going to be the same, right? So this is just another good illustration of how the contribution limit applies at the participant level. And since we've got the same profile, right? Income, age, objective, each person is going to be able to contribute the same. It would each go into their separate accounts, right? Each person will be able to contribute $66,000 for 2023, $69,000 for 2024, and then move that over to the Roth solo 401k. So hopefully those scenarios help to illustrate how the rules work. Now let's highlight the calculator. So if you go to our website, mysolo401k.net, There's a menu that goes left to right, home, about, solo 401k. If you go all the way over to the right under learn, you can click on online tools. You'll be able to then click through to the calculator, and it'll prompt you for different information like your age, your income, how your business is taxed. So you obviously enter your age. You would enter the income from line 14 of the K-1 less 1/2 of the self-employment tax. You would choose the unincorporated sole proprietorship, and you're going to be able to save this as a PDF. So now keep in mind that the calculator doesn't contemplate a scenario where someone is making contributions to a day job plan. Doesn't contemplate a scenario where someone is trying to make after-tax contributions. So you'd have to modify it, but it's definitely a useful tool in helping you figure out how much you can contribute. So now let's talk about the mechanics of making contributions. So of course you can write a check, make the check payable to the name of your solo 401k, write annual contribution, right? From a solo 401k perspective, it's totally acceptable to make a contribution as an electronic deposit. Now, we are helping our clients open up accounts at the bank or brokerage of choice. We've helped clients open up accounts at hundreds of different banks, many different brokerages. Of course, each financial institution is going to have their own procedure to be able to receive electronic deposits. Now, many clients want us to help them open up accounts at brokerages like Schwab, Fidelity, just to name a few. And many of those brokerages do not allow for an external electronic deposit from a third-party account where the name on the third-party account doesn't match the name on the account at the brokerage. Of course, the account at the brokerage would be opened up under the name of the 401k. So if you're trying to make a deposit from, say, a business account or a personal account, the names are not going to match. But one exception to that general rule with respect to brokerages would be Fidelity, which, based on experience, client feedback, Fidelity does allow for an external deposit electronically from an external account where the name doesn't match the name of the account at the brokerage. And then, of course, even if you do have the account at, say, a Schwab or one of the other brokerages that doesn't allow for the electronic deposit from an external account where the name doesn't match, one workaround would be to transfer the money to a non-retirement brokerage account at the same brokerage from the external account, and then move the funds from the non-retirement brokerage account over to the account at the brokerage for the solo 401k. Like we talked about, of course, you can make different types of contributions, pre-tax, Roth, after-tax. Those need to go into separate sub-accounts. Additionally, separate sub-accounts if you got different participants. Like we talked about, that's like you'd end up with 6 different accounts, right? Pre-tax, Roth, and after-tax for 2 participants for a total of 6. Those contributions from a solo 401k perspective, they could be deposited in one lump sum or a series of contributions. From a solo 401k perspective, it's perfectly acceptable to transfer the funds from a personal account or a business account. The key is that the contributions are going into the separate accounts for the different participants or different types of funds. They're being made by the deadline, right, et cetera, within the limits. So what is the deadline? Well, the deadline to make all types of contributions is the business tax return deadline, including any timely filed extension, assuming the plan was set up before the end of the tax year. So for 2023, assuming that you set up the plan, signed up with us before the end of the year, you're going to have until your business tax return deadline, including any timely filed extension, to make all types of contributions, right? March 15th or September 15th for a business tax as a partnership. Now, if you hadn't set up the plan before the end of the year, before the end of 2023, it would still be possible to set up a plan and be able to make the employer contributions as well as the after-tax contributions, as long as the plan is set up in time for those contributions to be deposited by the business tax return deadline, including any timely filed extension. So what are the different deadlines, right? Well, it depends on how your business is taxed, right? For a business that is taxed as a partnership, it could be an LLC taxed as a partnership. For 2023, the deadline is March 15th or September 16th if you file a timely extension for that 1065. Now for 2024, looking ahead to next year, the deadline for a business tax as a partnership is March 17th of 2025 or September 15th of 2025 if you file a timely extension. So now let's talk about more mechanics. How do I report the contributions? Well, for pre-tax contributions, those are reported on line 16 of Schedule 1 of the 1040. as well as line 13 of your K-1 using code R. If it's a pre-tax employee contribution, if it's a Roth employee, if it's a voluntary after-tax employee contribution, those are not reportable for a business that is taxed as a partnership. Now, for employer contributions, likewise, those are reported on line 16 of Schedule 1 of the 1040, as well as line 13 of your K-1 using code R. Keep in mind, if it's a Roth employer contribution, it also needs to be reported as taxable to the employer, to the employee for the year of the deposit. So remember we talked about, Secure Act 2.0 allows for employer contributions to be made as Roth contributions, but there was no clear guidance as far as how those contributions were to be reported. So almost a year later, the IRS comes out with IRS Notice 2024-2, which clarifies how those employer Roth contributions need to be reported. And per the guidance, those contributions are actually tax deductible, like a pre-tax contribution on the employer's return for the year for which the contribution is made. So let's say an employer contribution that's made in 2024, but made for 2023. So it's going to reduce the employer's taxable income for 2023 by being reported on line 16 of Schedule 1 of the 1040, as well as line 13 of your K-1 code R, right? It goes on the 1040 because it's a partnership, it's a pass-through. But then it increases the employee's taxable income for the year of the deposit. In this example, assuming in 2024. So at 2024 1099-R, so it would raise the income in 2024 because ultimately it needs to be taxable because it's a Roth contribution. It's a post-tax type of contribution. Now, voluntary after-tax contributions, remember, those are not, the actual contribution is not reportable, right? We see up here it's not applicable, but the subsequent transfer from the voluntary after-tax solo 401k subaccount to either the Roth solo 401k or Roth IRA is reportable on a Form 1099-R. And that's all part of making Mega Backdoor Roth contributions, which is the next webinar in our series here. We're gonna go through this deep dive discussion on the contribution rules that apply to partnerships, specifically focused on those who are trying to make Mega Backdoor Roth contributions, right? Because there's so many folks that want to make those contributions. We really want to have a deep dive session on that. So subscribe so you can get notifications of all the upcoming webinars. You'll be able to access all the recordings, etc. So what about making matching contributions, right? A good question, because many folks' experience with 401ks comes from working in, say, corporate America, where they had a 401k at their job and maybe they got a matching contribution. So a common question is, well, can I make matching contributions to the solo 401k? So the answer is no. Matching contributions only apply to full-time employer plans, not self-employed solo 401k plans, owner-only plans like a solo 401k. Solo 401k contributions only consist of the employee, whether it's pre-tax, Roth, or voluntary after-tax, and then the employer non-elective profit-sharing contributions. And what's noteworthy is, right, matching contributions, as the name implies, is really contingent on the employee making a contribution, right? Because there's something that the employer has to match, right? But as we saw with the different scenarios, someone might have maxed out their employee contributions to, say, their day job plan, and they're not able to make any employee contributions to the solo 401k. But with profit sharing contributions, non-elective contributions, there's no prerequisite for the employee to make a contribution that has to be therefore matched. So in other words, you can make employer profit sharing contributions even if no employee contributions are being made. What is not a contribution? Another good common question, right? Because there's other funds that are coming into the solo 401k. It could be money that you're rolling in from an existing retirement account, like a former employer plan or a non-Roth IRA. Could be earnings on your investment, right? Another popular reason that clients set up accounts is because they want to invest in alternative investments like real estate. Let's say you have rents coming from your rental real estate property that's owned in your solo 401k. That's other money coming in. Could be money that's being converted, right? Like we talked about with the voluntary after-tax contribution, right? The money is deposited as a voluntary after-tax contribution to that separate after-tax sub-account before it gets moved over to the Roth account, right? So here's money coming into the Roth solo 401k. could be paying back a 401k loan, right? Another common use case is that the fact that our plan allows for solo 401k participant loans, right? We can literally borrow money from your plan, but then you got to pay it back to your solo 401k. So that's another scenario where funds are being deposited into the solo 401k. So in all of these scenarios where funds are being deposited into the solo 401k, those are not contributions. So those don't count towards your contribution limit. Okay, so that takes us through the slides regarding the deep dive discussion on contributions. Let's spend a few minutes on the solo 401k tax credit. So our plan now qualifies for the $1,500 tax credit. So what exactly do we mean? So it's a $500 per year credit for 3 consecutive years. This comes under the Secure Act, which actually enabled or authorized other credits that apply to 401k plans. For example, the startup cost credit. But the startup cost credit is not available to solo 401k plans because in order to be able to claim a startup cost credit, one, the business needs to have non-owner employees participating in the plan, which of course with a solo 401k, you can't have a non-owner employees even working in the business, let alone participating in the plan, at least full-time non-owner W-2 employees in order to be eligible for a solo 401k. So therefore, a solo 401k plan is not going to be eligible for the startup cost credit. But there's another credit that was authorized in the Secure Act, which is the auto participation credit. So if your plan includes the auto participation feature, the business is now going to be eligible to claim that credit. So this could be for a brand new plan. It could even be for an existing, say, basic plan in a discount brokerage like Fidelity or Schwab that gets upgraded to our plan. And now that business is going to be eligible to claim the credit, right? Historically, we've always had lots of people that have started out with the basic plan at one of the discount brokerages, and now they want to upgrade to be able to take advantage of the service and features like the loan, the Mega Backdoor Roth, the ability to invest in alternative investments. And now another reason would be to be able to make their plan eligible to be able to claim the credit. And another point that's noteworthy is that this credit is not based on the cost to set up and maintain the plan. So unlike the startup cost credit, which of course the name applies, is limited, it's based on the costs to set up and maintain the plan. The auto participation credit, the business can claim the full credit, notwithstanding the fact that their cost to set up and maintain the plan, like with our plan, is less than the value of the credit. So if you set up a new plan here in 2024, the business would be able to claim the credit when they file their 2024 taxes, $500, and then again for 2 more years for a total of $1,500, as long as the business maintains that plan with the auto participation feature. If you already have a basic solo 401k plan, like at a discount brokerage, say at Fidelity or Vanguard or E-Trade, and then the plan is upgraded to our plan, now that business can claim the credit. If they do that, if they upgrade it here in 2024, the business will be able to claim the credit when they file their 2024 taxes, and then again for 2 more years for a total of $1,500. Like we talked about, the solo 401k tax credit is not a function of the cost. So our costs are less than $1,500, but that's okay. You're still able to claim the full credit. So we charge $650, which includes the $525 establishment fee, plus the first $125 annual fee. So the net cost for the first year is $150, right? After your $500 credit. But then for the second and third year, we're charging $125. That's due on the anniversary date of when you signed up. That covers the second year. But in that second year, your credit is going to be $500. So actually, your costs are less than the value of the credit by $375. And then again, in the third year, this is a tax credit, not a tax deduction. So with a tax deduction, you're reducing your taxable income upon which your tax liability is calculated. Whereas with a tax credit, you first figure out what your taxable liability is, and then you're able to reduce that tax liability dollar for dollar. So in that way, a tax credit is much better than a tax deduction. Again, in order to be eligible, you have to first be eligible to set up a solo 401k, and then set up a plan like ours that includes the auto contribution feature. So what is that auto contribution feature? Well, it sets a 3% default contribution percentage amount, but under the terms of that auto contribution feature, the employee, meaning you as the solo 401k owner, you have to be given the right to opt out of the default amount. So if you opt out of that 3% contribution default amount, you can still contribute, right, up to the max, subject to the rules like we've been discussing. But now you have all the flexibility to make the contributions in whichever amount, whichever interval or schedule you prefer. You're not even required to make contributions to qualify for the tax credit. Because again, under the terms of the auto contribution feature, you have the right to opt out of the default amount. Again, if you have an existing plan, you can upgrade it to be able to include the feature and now be eligible to claim the credit. You claim the credit by filing Form 8881, which is really the first step in the process, and the process will depend on how your business is taxed. So we have hosted a deep dive walkthroughs with all the steps that have to be followed based on how your business is taxed, so our clients can easily be able to claim that credit, and we make those walkthroughs available to our clients. So quick couple examples. Lindsay's self-employed, already has a solo 401k. As long as she amends her plan to include the auto contribution feature before the end of 2024, she's going to be able to claim the credit when she files her 2024 taxes, $500 for 2024, and then another $500 for 2025, and then 2026 for a total of $1,500, as long as she keeps that plan with the auto contribution feature. Whereas Brad doesn't have a solo 401k, but Brad is a solo attorney, so it doesn't have any employees, right, eligible to set up a solo 401k. If Brad sets up a solo 401k in 2024, he's going to be able to claim the $500 credit when he files his 2024 taxes, and then again for 2 more years for a total of $1,500, as long as he maintains the plan with that auto contribution feature. So that takes us to the end of the slides we wanted to share. Let's go through the questions. Let me just highlight the fact that we have our community, mysolo401k.net/my community. We host daily Zooms on our community, 1 p.m. Pacific, 4 p.m. Eastern. It's always free to join. All are welcome. We have forums where you can post questions 24/7. We have a webinar and video library with hundreds of videos and webinars in there. So all of that is available. It's just a great way to learn, hear what other people are asking, share the knowledge and experience. So please, you're welcome to come and participate. So thank you so much again. So I have 2 questions. I've had an existing solo 401k for a few years, but never set up a default auto enrollment or claim the credit. If I understand your materials correctly, I can do that now and then claim the credit. That is correct. I'm trying to convince you can do that for 2024, 2025, and 2026, as long as the plan is maintained with the auto contribution feature, like we just talked about. Thank you so much. But yes, I'm trying to convince a small business owner to set up a solo 401k with you. Can you still make employee contributions for 2023 or only employer? So for a business that is taxed as a partnership, right, which is the focus of today's session, it's too late to make employee contributions for 2023, but it's still possible to set up a plan and make employer and or voluntary after-tax contributions for 2023, as long as the plan is set up in time to deposit those contributions by the business tax return deadline, including any timely filed extension, right? So March 15th or September 15th, if you file a timely extension for the partnership tax return. Now, for a business's taxed as a sole proprietorship, the deadline is different. So the individual could set up a plan and make employee contributions. If the person set up a plan in time to be able to make employee contributions for 2023 by April 15th, then the individual could still do that and can still make 2023 employee contributions. Otherwise, the individual could set up a plan and make employer or after-tax contributions by their business tax return deadline, April 15th, or a timely filed extension, October 15th, if they file a timely extension for their 1040. So if they want to make, in short, if they want to make employee contributions for 2023, they'd have to set up the plan in time to be able to deposit those contributions by April 15th of this year. So those rules, that was some of the recent changes with the Secure Act. But So it's a little bit more complicated for a sole proprietorship, but we definitely can accommodate that, no doubt. Thank you so much for the good questions. Do other retirement contributions like a traditional IRA impact the maximum solo 401k contribution allowed? Does a traditional IRA contribution count against your net business income amount used for solo 401k contribution? So number one, the contribution limits that apply to solo 401ks are not impacted by contributions made to an IRA. So no, you do not have to aggregate when determining how much you can contribute. You don't have to reduce how much you can contribute by that IRA contribution. Now, with that said, just like making contributions to the solo 401k, you have to have earned self-employment compensation to justify those contributions, right? You can't save more than you earn. And what self-employment compensation is equal to depends on how your business is taxed, right? For this session, we're focused on partnerships. So let's use that as an example. So that would be your line 14 of your K-1 less 1/2 of the self-employment tax. That's your self-employment compensation. Now, likewise, when one is making IRA contributions, they have to make it based on their income, right? So if you don't have any income, you can't make IRA contributions. Now, the definition of income for purposes of making IRA contributions is broader, right? With a solo 401k, it's based on your self-employment income, right? You have a broader definition of income. So you could use other income to justify an IRA contribution, right? You can't use W-2 wages to justify a solo 401k contribution, W-2 wages from a day job, but you could use W-2 wages from a day job to justify an IRA contribution. Now, with that said, if your only source of income is your self-employment compensation and you're using all of your self-employment compensation to justify solo 401k contributions, you're contributing 100% of it, you can't use the same dollars to justify contributions to both a solo 401k and an IRA. So hopefully that helps. What happens if you have excess contributions from the employer profit sharing portion? So good question. So we have a wealth of information on our website, but if you have an excess so when you have an excess contribution, the rules that apply depend on what type of contribution it is, right? Like if it's an excess employee contribution, that can be, there's an opportunity to remove that by April 15th of the following year. But if it's an excess employer contribution, you don't have that same option. So we have a good post on our website regarding dealing with excess contributions, and it breaks it down based on the different contribution type. So let me chat over a link to that post. I'm going to put it on the screen here, but let me see here. I just chatted over, but please take a look at this. Hopefully that helps. It breaks it down exactly what has to be done. So is there any requirement if I want to make voluntary after-tax contributions? I heard that the Mega Backdoor Roth Solo 401k is only available to certain type of big companies. Is it true? Well, you have to have no, it's not true. I mean, you can have a plan like ours that allows for voluntary after-tax contributions. So you have to be eligible to set up a plan, meaning you're self-employed with no non-owner, non-spouse, full-time W-2 employees. You have to have a plan like ours that allows for voluntary after-tax contributions. You have to deposit those voluntary after-tax contributions into a separate voluntary after-tax account, right? You got to consider those voluntary after-tax contribution limits, the deadlines, and then those funds get moved over to either a Roth Solo 401k or a Roth IRA. So that subsequent transfer is going to be reportable on a 1099-R. You want to work with a company like us that has a deep experience like we do in helping clients that are trying to make those voluntary after-tax contributions, those Mega Backdoor Roth contributions, to understand and to help them comply with all those technical requirements. For example, we handle the 1099-R that has to be issued for the subsequent transfer. And like I mentioned at the outset, please subscribe, because the next webinar in this series is going to be focused on the contribution rules for a business tax as a partnership, but specifically focused on the Mega Backdoor Roth scenario. So all the mechanics, etc. So if you subscribe, you can get notifications. You'll be able to watch the recording if you can't make it live, etc. Thank you so much. Can the solo LLC of investment property do the profit sharing contribution and post-tax contribution as well? Well, so I'm understanding that this is a scenario where someone's solo 401k is invested in a real estate investment and maybe holds that real estate investment via an LLC. So it's an LLC that's owned by the solo 401k that owns, say, the investment property. So any returns from that investment that come out of the LLC need to go back to the solo 401k. And like we talked about, that's not considered to be a contribution. So there's no limit on that contribution. But at the same time, one wouldn't use the investment income from their solo 401k investment to make that or somehow characterize that as a contribution, right? So if you invested using pre-tax dollars, the investment's going to come back to your pre-tax account on a tax-deferred basis. Hopefully that makes sense. Appreciate the good questions. Thank you so much for the good participation. All right, we'll give it another minute here. Please like and subscribe. Like I mentioned, you get notifications of all the upcoming webinars. Please participate in our community. We have daily Zooms. You can post questions in our forums 24/7. We have a deep dive library of videos and webinars. So there's lots of great ways to learn and to share the knowledge. We'll just put this up here just to highlight. Thank you so much, everyone. Take care.